Okay, so you think Tesla is a car company, it has cars. It builds cars, it sells cars. You see them at traffic lights, in parking garages, pulling silently into driveways. The company is named after a physicist. Its logo is on showroom floors in shopping malls. From the outside, this looks like an automobile business, and a fairly expensive one at that. You are wrong. Tesla is not a car company the way Toyota is a car company, or Ford is a car company, or any of the 100-year-old manufacturers you learned about in school. It is something else entirely, something the traditional language of the auto industry cannot quite describe. And that gap between what Tesla looks like from the outside and what it actually is on the inside is worth roughly $800 billion on a good day. So let's figure out exactly where that number comes from, and whether it is real. Here is the paradox sitting at the center of modern financial markets. Toyota delivers between 8 and 10 million vehicles every single year. Ford moves around 4 million. Tesla, in 2025, delivered approximately 1.6 million. Less than Toyota, less than Ford, less than Volkswagen, Stellantis, Hyundai, and General Motors. And yet Tesla's market capitalization has periodically crossed $1 trillion and consistently hovers between $600 billion and $1 trillion, exceeding the combined value of most of those competitors put together. Traditional auto companies trade at price-to-earnings multiples of 5 to 15 times. That is what capital markets think a car business is worth. Tesla has traded at multiples between 200 and 300 times earnings. That is not a car company valuation. That is not even close. So the question is not really about Tesla. The question is about what kind of business investors think Tesla actually is, and whether they are right. Everything that follows is an attempt to answer that question honestly. To understand the valuation, you first have to understand how radically different Tesla's structure is from every legacy automaker on the planet. Traditional manufacturers are system integrators. They design vehicles, but they purchase components, electronics, software modules, safety systems from hundreds of Tier 1 and Tier 2 suppliers. Every one of those suppliers takes a profit margin. Every one of them creates a dependency that slows down the manufacturer's ability to change or innovate. Ford's debt-to-equity ratio sits above 400%. Toyota operates similarly, laden with financing subsidiaries and supplier networks built over decades. There is also the dealer problem. Legacy automakers sell wholesale to independent dealer networks. The dealer marks up the vehicle, takes the retail margin, controls the customer relationship, and insulates the manufacturer from real-time feedback. The manufacturer gets a check. The dealer gets the customer. Tesla eliminated that entire layer. Direct-to-consumer sales mean Tesla captures the retail margin itself, controls the pricing, and receives a continuous stream of live data from every vehicle on every road in every country where it operates. Ford sells you a car and loses you. Tesla sells you a car and keeps you. Most corporate executives are optimizing for something that happens every 90 days. Quarterly earnings, analyst expectations, the next conference call. If earnings miss by a few cents, the stock drops. If the stock drops, the board gets nervous. If the board gets nervous, the CEO gets cautious. Elon Musk does not run this way. Tesla willingly absorbed enormous short-term losses to build infrastructure that competitors cannot replicate quickly. Years of burning cash on Gigafactories, battery research, autonomous software, and AI compute clusters before any of it generated a return. Ford pays shareholders a dividend of around 4% through periods of thin margin. Tesla took that same capital and built factories. The question was always the same. Are you optimizing for the next quarter, or are you building a position that is almost impossible to attack in 10 years? The answer shapes everything about Tesla's economics. Tesla controls things that no other automaker controls. Battery chemistry developed in-house with proprietary cell formats. The vehicle operating system written entirely by Tesla engineers, updated remotely without a dealership visit. Custom manufacturing tooling, the retail network, the supercharger infrastructure, the energy ecosystem, all of it owned. All of it controlled. Compare this to Apple. Apple does not make the most popular smartphone because it has the best chips. It makes the most popular smartphone because hardware, software, and services are so tightly integrated that switching feels genuinely costly. Tesla is attempting the same thing at industrial scale with physical machines that weigh 5,000 pounds during the global semiconductor shortage in 2021 and 2022. Legacy automaker production lines went dark because a missing $2 microcontroller halted assembly of a $40,000 vehicle. Tesla's engineers rewrote vehicle firmware in-house to accommodate alternative chips. Production continued. The competitors who outsourced their software architecture to suppliers had no equivalent option. Vertical integration is not just an operational preference. It is a structural advantage that compounds over time. The single largest cost in an electric vehicle is the battery pack. historically 30 to 40% of total manufacturing cost. Whoever drives that number down the fastest does not just earn better margins. They determine who can afford to price competitively and who cannot. Tesla developed proprietary cell formats, most recently the 46N80 cylindrical cell, and manufacturing processes designed to reduce cost per megawatt hour. The battery pack is not just a power source. It is a structural member of the chassis itself. Integrating the battery into the floor eliminates separate housing modules, reduces part count, and lowers weight by co-locating battery cell manufacturing inside the same Gigafactory where the vehicle is assembled. Tesla cuts shipping costs and shortens the supply chain to nearly zero distance. This is why the Gigafactory matters beyond its size. The factory is not just a building, it is the economic engine. Tesla approaches manufacturing facilities the way an engineer approaches a product: build the machine to build better machines. Each Gigafactory is a unified industrial system rather than a collection of retrofitted legacy assets. Gigafactory Shanghai became Tesla's most efficient production hub, achieving over 95% localized supply chain sourcing. Gigafactory Berlin provides localized production inside the EU, bypassing import tariffs. Gigafactory Texas houses advanced gigacasting operations and structural battery pack assembly. The economics are simple and brutal. Fixed capital costs are amortized over more and more units. Every additional car rolling off a Gigafactory line reduces the fixed cost burden per vehicle. At sufficient scale, the cost falls to a point that competitors without equivalent scale simply cannot match. Scale is profitability. And Tesla built the scale while competitors were still holding board meetings about electrification timelines. Every car built by a traditional manufacturer depreciates from the moment it leaves the dealership. The hardware ages. The software does not update. The features you bought on day one are the features you have on day 1000. Tesla turned the automobile into something that gets better after you buy it. Over-the-air updates deploy new features and performance improvements directly to every vehicle in the fleet without a service appointment. More significantly, Tesla sells features after the initial purchase. Acceleration upgrades, connectivity subscriptions, heated seat activations. These are digital products. The marginal cost of delivering them to one more customer is effectively zero. A traditional automaker earns its profit when the vehicle is sold. Tesla earns revenue at the point of sale, then continues earning from the same customer for years. The gross margin on software features dwarfs the margin on hardware. This is why investors reach for technology company valuation frameworks when they look at Tesla. The revenue model starts to look less like selling trucks and more like selling subscriptions. If over-the-air software is the hidden goldmine, full self-driving is the vault underneath. FSD is Tesla's advanced autonomous driving capability, operating in supervised mode with customers paying either an upfront lump sum or a monthly subscription. The software is delivered over the air. Once built and trained, the marginal cost of delivering it to one more vehicle is nearly zero. Tesla collects cash upfront for software that does not yet do everything it promises. As capability improves through fleet data collection and neural network retraining, the product gets closer to what customers paid for. And the cost of that improvement is borne by AI training infrastructure, not individual vehicle production. If unsupervised level 4 or level 5 autonomy is achieved at commercial scale, every Tesla on the road becomes a revenue-generating asset capable of earning per-mile fares while the owner sleeps. The vehicle transforms from a depreciating consumer purchase into a cash-generating commercial asset. If this works, truly works, Tesla does not become the best car company in the world. It becomes the operating system of autonomous transportation. The vehicle is just the hardware. Before we go further, it is worth counting Tesla's actual revenue streams because the list is longer than most people realize. There are automotive sales, the obvious one, software subscriptions and feature upgrades, the energy business, solar products, Powerwall residential storage, and Megapack utility-scale deployments, services and maintenance revenues. And then there is one that surprises almost everyone when they hear the number: regulatory credits. Legacy automakers are legally required to meet fleet emission standards. If they fall short, they purchase regulatory credits from manufacturers who exceed those requirements. Tesla, producing only zero-emission vehicles, generates credits automatically and sells them to competitors who need them to stay compliant. Since 2019, Tesla has generated over $11 billion in cumulative regulatory credit revenue. Because these credits have no cost of goods sold, Tesla did not produce them, it earned them by existing. The gross margin is effectively 100%. Ford, General Motors, and others have been paying Tesla for the privilege of continuing to sell gasoline-powered vehicles. The competition funded the manufacturing infrastructure Tesla now uses against them. Speaking of things that are more valuable than they first appear, if you are finding this breakdown useful, consider subscribing to the channel and hitting the like button. It genuinely helps more people find content like this, and there is a lot more where this came from. Tesla did not build its early business without policy tailwinds. California's zero-emission vehicle program created the regulatory credit market that generated billions in nearly pure profit revenue. Federal EV buyer tax credits lowered the effective purchase price and accelerated consumer adoption. EU fleet emissions compliance rules pushed European manufacturers to take electrification seriously years earlier than they otherwise would have. These were real structural advantages, and Tesla leveraged them aggressively and early. But here is the critical economic distinction. Tesla used that policy window to build manufacturing scale, drive down costs, and develop software infrastructure. When incentives began phasing out or fluctuating across jurisdictions, Tesla's cost reductions meant it could compete profitably without them. Legacy automakers made a different calculation. Rather than building EV platforms urgently, many chose to purchase regulatory credits from Tesla, cheap in the short term, catastrophic in the long term. They delayed building internal EV capabilities, while Tesla used the credit revenue to build the factories those same automakers would eventually need to compete against. Traditional manufacturers operate on a wholesale push model. They build cars based on production forecasts, ship inventory to dealer lots, and wait for customers to show up. If the forecast is wrong, inventory accumulates. Accumulated inventory gets cleared with discounts that compress margins. Tesla runs a live digital order book. Orders flow in, factory scheduling responds, and vehicles ship directly to customers. When regional demand shifts, say Chinese domestic orders soften, Tesla reroutes Gigafactory Shanghai production toward European or Asia-Pacific markets, maintaining factory throughput without building inventory surplus. The factory stays full. The margins stay intact. Pricing adjusts dynamically based on real demand signals rather than guesswork. Tesla's cost structure gives it a weapon that legacy automakers and EV startups cannot defend against. The ability to cut prices while remaining profitable and hold those prices long enough to damage competitors who cannot match them. When Tesla enacted global price reductions on the Model 3 and Model Y, the goal was not simply to boost its own volumes. The deeper intent was to compress operating margins across the entire EV industry. Unscaled legacy EV programs were already losing money per vehicle at higher price points. Tesla lowered the ceiling. Competitors faced an impossible choice: match prices and absorb losses that widen with every unit sold, or hold prices and lose market share. This is the economics of industrial dominance. You do not need to make your competitors fail. You just need to make their economics progressively worse until they exit the segment voluntarily. Ford is one of the largest corporate advertisers on the planet. Toyota spends billions annually on traditional media. Tesla's advertising budget in 2023 was approximately zero. That is not a typo. Tesla built global brand recognition while spending nearly nothing on paid media, redirecting those savings into supercharger infrastructure, battery R&D, and manufacturing technology. The brand spreads through three mechanisms that cost the company almost nothing. Elon Musk's public presence generates continuous global media coverage worth hundreds of millions in equivalent paid reach. Tesla's supercharger stations on major highway corridors are physical billboards for the brand's ecosystem. And Tesla owners are unusually vocal advocates. High satisfaction scores translate directly into word-of-mouth referrals, turning one-time vehicle purchases into ongoing customer acquisition at zero additional cost. Low customer acquisition cost means more cash available for the things that create competitive advantage. Beyond advertising, Tesla has built something more durable. An ecosystem that creates genuine switching friction. The Tesla mobile app manages vehicle functions, charging sessions, and energy products. The supercharger network works seamlessly within Tesla's ecosystem. Over-the-air updates add features and improve performance continuously. For a Tesla owner, switching to a competitor does not just mean buying a different car. It means leaving a digital environment that has shaped how they interact with transportation. That friction has real economic value. Repeat vehicle purchases, FSD subscriptions, energy product adoption, and referral behavior expand customer lifetime value well beyond the initial sale. Lower acquisition costs combined with higher lifetime revenue per customer. In software, this is the playbook for high multiple valuations. Tesla is applying it to a physical product that weighs 2.5 tons. Traditional auto companies trade at 5 to 15 times earnings because they have low operating margins and revenue tied to cyclical consumer spending on large discretionary purchases. Capital intensity is high, debt is high, growth is slow. Technology companies trade at 100+ times earnings because software scales without proportional cost increases. Once the code is written, shipping it to 10 million users costs only marginally more than shipping it to 1 million. Margins expand as the user base grows. Revenue becomes recurring rather than transactional. Tesla has a physical manufacturing base that looks like the first category, but it also has a software stack, an AI compute infrastructure, an energy storage business, and an autonomous mobility bet that look like the second. Capital markets are valuing the combination by weighting future technology possibilities against present manufacturing reality. Investors are not paying for what Tesla is. They are paying for what Tesla could be, and for the argument that no one else is positioned to get there first. Autonomous driving is, at its foundation, an AI problem. And AI problems are solved with data, enormous quantities of high-quality, real-world training data. Competitors relying on LiDAR sensors and pre-mapped HD city maps face a fundamental constraint. You have to map every city before you can operate in it. The bottleneck is geographic and sequential. Tesla collects real-world driving video from millions of customer vehicles globally, simultaneously, every single day. Complex edge cases, unusual intersections, erratic drivers, severe weather are automatically flagged and uploaded to Tesla's centralized AI training clusters. Neural networks are retrained on these scenarios and deployed back to the fleet via over-the-air update. The fleet gets safer. The AI gets better, which attracts more customers, which expands the fleet, which generates more data. Competitors who lack fleet scale cannot replicate this advantage by spending money. They would have to spend time, years of accumulation, that Tesla has already completed. Data, at sufficient scale, is a structural moat that cannot simply be purchased. Most discussions of Tesla focus entirely on the car. This is a significant analytical error. Tesla Energy supplies residential storage products, Powerwall and solar roof, and utility-scale systems under the Megapack platform. As renewable energy generation expands globally, power grids face intermittency. Solar generates during the day, wind when it blows, neither reliably at peak demand. Grid-scale battery storage solves this mismatch. Megapack deployments hit record levels through 2024 and 2025, with single-quarter storage reaching 13.5 gigawatt-hours and annualized energy segment revenues exceeding $12 billion. Critically, the energy segment is growing faster than automotive, with expanding gross margins. Integrated with Tesla's AutoBidder software, Megapack installations allow utilities to automatically trade stored electricity into wholesale energy markets in real time. Tesla is not just selling batteries. It is selling the operating software that manages a nation's energy grid. That is a fundamentally different business than selling cars, and it is scaling fast. Tesla's ability to price dynamically without destroying its own margins depends on continuously reducing what it costs to build a vehicle. The most visible example is gigacasting, replacing hundreds of individual stamped sheet metal components and robotic welds with single-piece die-cast